I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, a bumpy ride. Peloton makes its public debut and the stock opens below the IPO price. We'll hear from CEO John Foley, who cited some disappointment. Plus, chipmaker Micron reports earnings. Shares fall in after-hours trading after gross margin and profit outlook miss estimates. We'll have details. And antitrust probe overload. The U.S. Justice Department launches its own Facebook probe. This, as the social network is already the focus of a Federal Trade Commission investigation. But first, to our top story. Peloton falling as much as 9.5% after raising more than $1 billion in its U.S. initial public offering. It's the latest unprofitable startup to struggle in its trading debut. But CEO John Foley remains upbeat about Peloton's future. He spoke with Bloomberg's Jason Kelly at the NASDAQ.
The biggest thing is we're playing the long game. We see this as, literally building more millions and millions of subscribers around the globe in the coming years. And now we have the money to do that. We are fully funded after today's primary, so we're feeling confident.
And when you think about sort of the last couple days and really the last couple weeks, you mentioned the markets. I mean, WeWork obviously is on everybody's mind. It's a tricky IPO market, to say the least. Do you have a sense of sort of where the miscalculation was, or if there was one?
Yeah, I will tell you, Jason, this is my 8th fundraise for Peloton, and it's always been this funny thing where people either see it or they don't. And so there's believers and there's non-believers. The people that have believed and bet on Peloton and invested in Peloton for every one of the rounds for 8 years now have been very, very, very happy, and we're going to continue to delight the capital partners who invest in us.
You mentioned fully funded. So what are you going to do with some of that money? What does expansion look like at this point?
So we're doing things like building a $50 million television streaming studio here in New York City, another $50 million studio in London, where we'll hire our foreign language instructors. So the German instructors are being hired out of the London studio to stream to our German market, which we open in, I think, 60 days. So we're investing in new content. We're investing in new verticals. We brought the tread to market last year in new markets. We have Canada and the UK and Germany. It's really, we're in investment mode. So someone earlier today was saying, you're losing money. It's like, no. It's semantics. We're investing money, and we feel very good about what we're doing.
And how do you feel about the consumer market? You sell a very high-end product. We are in a bull market. We continue to be, other than some of the volatility that we're experiencing. What do you hear back from your customers, and maybe more importantly, your potential customers about their willingness to, write a big check or charge something pretty big on their credit card? Yeah.
So one of the most important things we think about at Peloton is the optics on affordability. If you have a Peloton bike and you and your live-in partner ride it, it's an insane value vis-a-vis anything else. So we, interestingly, I know, Jason, you kind of wrote the book on fitness, so you know this, but fitness has been a recession-proof category for the last 15 years. More dollars went into fitness in 2008 and 2009 as they did every year. So it's a growth, secular growth over the last 15 years. And we think if we create the best value in fitness, if you ride your bike, on average, our bikes are ridden 12 to 14 times a month. So you divide that by 39, you're paying a couple dollars for a workout. That's obviously, orders of magnitude better than going to the boutique fitness world. And we're going to show over time that's an even better value than going to the gym.
You have described the company in the S1 and in the roadshow as all sorts of things, a technology company, a media company. It obviously does a lot more. Where will you be primarily spending money? Is this a content push that's coming?
Yeah, I would say at our core, we cannot hire software engineers fast enough. So we are a software company, tech company at our core. We've had to learn our way into media. Now we have 13 Emmy award-winning producers, and we just hired this fantastic new chief content officer in Jen Cotter. So she's going to build one of the most special, media divisions in any category. But at our core, to your question, the investment is going to go into technology. Of course, we're going to open more retail stores and logistics and more markets and all this stuff that starts to show how multifaceted Peloton is. But certainly, software engineering is at our core.
That was Peloton CEO John Foley. Now to discuss the company's first day of trading, I'm joined by Bloomberg's Crystal C. and Shanali Bossack. Crystal, let me start with you. Down about 11% today. What was the biggest concern from investors? Why it closed so much lower than where it priced yesterday?
Like John, the CEO, has said during the roadshow, it has been a pretty binary story. You either have a bunch of people who believe that Peloton is going to change the entire fitness landscape, change how people work out, change how they think about workout, or you have people who just think that this is a business model that cannot sustain. So that has been a story that has been, in the investor's mind. You either believe it or you don't. So that has made it a pretty interesting dynamics in the deal pricing, because you have a very bipolar set of feedbacks from investors. So that is probably why we're seeing that the deal is struggling to open this morning, and we've seen the price fluctuate in the open, and at the end of the day it's closing below. But more of the criticism on this deal has really been the profitability of the company. It is still unprofitable, and investors want to see an end to that.
Shanali, was valuation a concern today?
It certainly was. You had a valuation here that was about double what they saw in their last private funding round, and yet he's saying he wants to make it into a content company, right? However, the $29 a share left it at more than $8 billion, which, as we know, is more than Netflix if you do it at a price-to-sales basis in 2020 sales. So it was quite expensive. But with that said, also, and by the way, Ashwat Damodaran, the NYU valuation professor, believes that should have been more than $23 a share. So it was a little more expensive than people were thinking. With that said, also, I've got to say, Peloton, like Smile Direct Club, are not a typical technology company, like WeWork as well. And so you see these non-traditional technology companies having a harder time selling themselves as technology companies.
Crystal, the CEO in that interview really touted the health of the balance sheet, citing cash, saying that we're fully funded. After today, are there concerns about the health of the balance sheet?
So I also spoke to the CFO of the company just now. She was saying that this really is a funding event for them. Whether the stock price end at the end of the day, it doesn't really matter. They have very happily raised $1 billion. And they are going to deploy the capital, like they said, into content. And, software content, that is a kind of valuation that they're talking about. We haven't actually seen, that much of a sell-off in the market yet. But in terms of, where they deployed their content, they've mentioned where they've deployed their capital. They've mentioned international expansions, content, and, tapping the existing base and potentially even rolling out a new hardware.
Shanali, you heard Crystal mention hardware. What's more important, a $2,000 bike, a $4,000 treadmill, or a $40 monthly subscription revenue that analysts and investors can really hang their hat on?
Exactly. The subscription revenue is something that is recurring. It's still about as much of the revenue and profit as a percentage as it was the last couple of years. So they haven't seen that grow super significantly. So people are going to want to see more of that. Not to mention the hardware. We've been talking about all these costs, hundreds of millions of dollars in marketing, but also international expansion. But the hardware is also quite expensive, and there's hundreds of millions of dollars also poured into there. So the cost base has been rising quite a bit, and that's not something that we're able to see them put a clamp on. And so for investors to bite onto this story is going to be a challenge when you're not seeing recurring revenue.
Bloomberg's Shanali Bossack and Bloomberg's Crystal C., thank you both for joining me. Now, Tesla saw their share spike in the most in 3 months on Thursday. This is after the CEO Elon Musk told his staff that the car maker has a chance to top the vehicle delivery record set in the second quarter. In an email to staff, Musk said that Tesla has a shot at achieving the first 100,000 vehicle delivery quarter. Tesla reported deliveries of more than 95,000 vehicles in the second quarter. And coming up, the clock is ticking for WeWork to raise billions. We look at the struggles ahead for its new leadership team next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. It seems the hits keep coming for WeWork. News late Thursday that WeWork's chief product officer, Chris Hill, is set to depart the company. This comes days after co-founder Adam Neumann said he would step down in order to salvage that IPO. The company has seen a rash of departures of other executives as well in recent weeks. And then this comes amid a dash for cash. Now, WeWork is in talks with Goldman Sachs and JP Morgan about a new $3 billion loan, but there's a catch. Any such deal would mean returning hat in hand to its biggest investor, SoftBank. Joining me to discuss in Atlanta, Synovus Trust Senior Portfolio Manager Dan Morgan, and in studio with me, Ellen Hewitt, who has been tirelessly covering WeWork. So walk me through this new loan, $3 billion. Who gives that money?
So that's going to come likely from a consortium of banks. And as you said, it's contingent on getting equity from a different funder, most likely SoftBank. The whole thing is this plan that's really being developed kind of as we speak, because there have been so many changes for the company in the last 4 days. As you said, the CEO has stepped down. His wife has also left the company. She was a co-founder and CEO of the education arm of the company. And there has been a lot of intrigue swirling around other executives and employees at WeWork who have been personally close to the Neumanns. It seems like the new co-CEOs are interested in, sort of
bringing in their own team.
Yes, cleaning house.
Talk to me then about those new co-CEOs. Who are they? What do we know about them? And if they are cleaning house, who do we think they'd likely turn to?
So the new co-CEOs are Artie Minson and Sebastian Gunningham. These are both executives at WeWork who notably have experience with public companies outside of WeWork. So Sebastian is from Amazon. Artie Minson was CFO at Time Warner Cable. So they have some ties to WeWork, but not too many. WeWork is a company where there were a lot of people who had been there for many years, especially people who had been close to the Neumanns. There was a lot of people who had personal friends of Adam from his childhood or relatives. Chris Hill, the chief product officer you just mentioned, as we reported just recently, he'll be leaving the company. He is Adam's brother-in-law. So there's a lot of connections in there, and I think the new CEOs, the sense I'm getting is they're interested in trying to at least strike a sense of this is a different era.
Dan, let me bring you in here. Thank you for joining me from Atlanta. As you take a look at WeWork and the financials and the fact that if they don't IPO, they need more money soon, is that still the biggest concern, the financials of this company?
Well, you're right, Taylor. I mean, they need the IPO to secure about $6 billion in financing. They're currently burning about $2.4 billion in terms of cash flow. They were hoping to get about $3 billion in cash on the balance sheet from this deal. So that's the real driving force for them right now, is obviously getting the money from the IPO so they don't have to rely on like a SoftBank or someone else to fuel their growth throughout the remainder of the year. So I think that's really the driving force going forward to try to push this IPO and get it done more than anything else.
Dan, you talk about, raising cash, and that's sort of the revenue, the left side of the balance sheet. On the right side, or the expenses, a lot of it has to be perhaps maybe cutting back on some of the fat. We had the co-CEOs come out and write an email to employees that we anticipate difficult decisions ahead. What would you like to see from this company? Is it more layoffs? How do they cut excess expenses?
Well, you're right, Taylor. I mean, if you think about their model, their biggest expense is location operating expense, which is basically the cost of the leases that they have to take on. Now, based on the last data that we have in the S1 filing, that averaged between 80 to 85% of their total revenues. But I think what we'd like to see, Taylor, coming into this third quarter, which they're going to have results here in the next couple of weeks, is some sort of steps by these new CEOs in terms of showing that we are cutting costs. We are trying to drive this thing down to profitability. Because right now, as you know, their EBITDA is like 1.7. For every dollar they make, they lose money. So at a very, very fast pace. So just trying to show some discipline and trying to show that they're trying to get at the end of the tunnel in terms of driving some profitability would be absolutely huge. But right now, where the model's set, it's very difficult.
Ellen, when we talk about WeWork, you can't mention WeWork without mentioning SoftBank. Have they been the enablers here?
That's a great question, and a question that I think people are going to be examining for the next few months, if not longer. This idea that money came so easily to WeWork. I mean, they had to sell equity, but they had no shortage of venture funding available to them. I remember interviewing Adam Newman in April, and he talked about, SoftBank is amazing to me. They've given me $10 billion. And the way that he thought about it, it was clear that they had given him the cash to build this incredible company. And now we're seeing just how many of the ventures that WeWork had that was outside of their regular business of renting out office space, those are the things that are seemingly on the chopping block as we go forward. And that includes stuff like the elementary school that they run. They have 2 residential dorm buildings. I mean, they're going to have changes in these things. And I think we're going to start, and as we've reported, it seems like job cuts are part of that as well. And those will likely be outside of the WeWork core business.
Dan, talk to me a little bit about SoftBank's role. Have they changed the VC investing landscape, given what a powerful, dominant force they are? Have they just changed the way the private investing market works?
Well, I think so, because the fact they have so much money, and like you were talking about before, the willingness to lend it out not only to WeWork, but you look at all these unicorn deals, they're connected in a lot of them, and just the fact that there was so much money that was being put into their various funds that they had to distribute out to all these deals. So now you've kind of hit this point like, wait a minute, what's going on? We had Lyft, we had Uber, we have these other companies. Stocks are trading below the IPO prices. You look at Pinterest, some of these other ones. So now those people are starting to think, well, can this model continue for SoftBank? Can they keep giving this money away? And the end result will be everybody gets happy and they get their money back. And the market right now is kind of saying no.
Yeah, public markets right now certainly seem to be in charge. Bloomberg's Ellen Hewitt, thank you for joining me. Dan Morgan of Synovus, you're going to be sticking with me. Because coming up, it is the global microchip market. It is not yet in the clear. How global trade tensions are impacting Micron's future. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. There is word now that Endeavor Group is set to pull its IPO. It comes on the same day when Peloton opened lower than its debut share price. Earlier Thursday, Endeavor, which has a stake in the operator of UFC, lowered its IPO price range to about $26 to $27 from the previous earlier range of $30 to $32. It also cut the offering size to 15 million shares from 19.4 million. And shares of Micron falling in after-hours trading after the company gave a disappointing profit forecast, suggesting that a memory chip industry slump isn't over yet. The chip maker's guidance means that sales are on course to decline by more than 20% year over year for a 4th straight quarter. Still with me to discuss the forecast and Micron's current 4th quarter earnings in Atlanta, Synovus Trust Senior Portfolio Manager Dan Morgan. Dan, you know better than me. I don't care about the current quarter because it's over. I care about the future forecast, and that was a disappointment. Do you agree that that forecast was disappointing?
Well, Taylor, everybody was looking for this quarter, which is their 4th quarter 19. They have a different fiscal year than calendar year, to kind of be the low point in the valley. And that guidance going into their upcoming 1st quarter for 2020 would show some sort of improvement. Now, they did, as you talked about, revenue of about a little over $4.8 billion. On the 4th quarter, they guided for $5 billion plus or minus $200 million. So that kind of puts you a little bit on the high range from that perspective. But I think the real thing to focus in with this Micron report was that GAAP gross margin came in at 28%, and they guided for 24 to 27% gross margin going into the 1st quarter of 2020. So what it leads us to come to the conclusion is, like you were saying, is that everybody was looking for this to be the bottom of the valley, and then we're going to start going back up the staircase starting in the 1st quarter of 2020. And unfortunately, based on the guidance, it kind of looks like it's going to be somewhat flat or about the same, or even slightly down in regards to gross margin. So I think that's what really disappointed people in terms of the headline news coming out of Micron.
Dan, I want to show a chart that I'm showing to our Bloomberg audience inside the terminal that I have here at GTV Go. And interestingly enough, we talk about NAND and DRAM memory chip prices. And this is really, frankly, why the analysts were so bullish coming into this quarter, because we thought NAND and DRAM prices were bottoming out. Does the Micron earnings suggest that perhaps that call was too early?
You know, Taylor, I think it might be just because, as you mentioned, we've seen DRAM prices in the last quarter were down about 9%. So that's total DRAM revenue. And as you mentioned, you know, it's kind of ticking down from what we saw over the last, let's say, 4 or 5 quarters. And then the expectation, as you mentioned, in terms of analysts, was it's going to start to pick up again. And at least based on the remarks that we have coming out from Micron that they had with their results, it's not showing the type of improvement that we were kind of hoping for. It's kind of just showing, you know what I mean, a continuation of kind of the same, a lot of uncertainty around tariffs and Yahweh and so forth. So because of that, I think maybe you could make the case that analysts were a little bit ahead of themselves, maybe a quarter or two, in terms of predicting that inflection point, and things are going to really start taking back off again.
What is the bottom line impact from trade and tariffs?
Well, Taylor, in the release, they talked about the relationship with Yahweh in regards to concerns about getting an approval from the Commerce Department to continue to sell into that company. You also have to realize that, you know, Micron Technology, of all the semiconductor stocks, derives about 50% of their revenues come out of China. So they are very, very heavily entrenched in that debate. So because of that, that is just a huge headwind for them in regards to being able to recover, along with the fact that we have a very mature cycle in smartphones and PCs, and we have a little bit of an indigestion going on right now in the infrastructure as a service cloud space. So you have all these things kind of coming against them, but obviously China and tariffs are a big part of those headwinds.
Dan, we sound pretty negative on the company, but when we expand out and look at the general chip industry, I am shocked at the relative resilience. If we take a look at another chart here that I'm showing on my Bloomberg terminal, it's the fact that DRAM prices, like you and I have been talking about, have been bottoming out, but the SOX, the broader gauge of all those chip makers, has just continued to climb. Are you surprised at the relative resilience of this sector?
What's amazing, Taylor, is I think, and you have the numbers in front of you, the SOX, I believe, is up 36% year to date, correct? If you look at the overall technology sector, it's up about 28%, and both those numbers are double, right, the S&P 500 and the Dow Jones, right, in terms of performance year to date. So you're right, there's just a tremendous anticipation that things have bottomed and things are going to start improving. So you have this huge run-up in the SOX, and believe it or not, it is higher than it was before we hit the peak, and then we dropped down as of last summer when we had kind of this pullback from China and everything else. So it's interesting, the enthusiasm for the sector.
Tons. Dan Morgan of Synovus, thank you for joining me. And coming up, we continue our discussion on all things about Peloton's bumpy first trading day. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Back to our top story of the day. It was a bumpy ride for Peloton. After initially setting the IPO price at $29 a share, the price fluctuated until settling on an opening of $27. Now, the opening was the third worst for a mega IPO since 2008. The process of picking an opening price took a little bit less than 3 hours. Now, remember, Peloton, of course, still unprofitable. CEO John Foley told Bloomberg that the concern Peloton is losing money is, quote, semantics. To discuss, I'm joined by Techonomy founder David Kirkpatrick, and here with me in San Francisco, Joe Vobril of Favahar Partners.
Hi.
So, Joe, you're here. Let me start with you.
Sure.
What happened today with Peloton?
Well, I think what you're seeing is a reflection of a complete structural change in the way the IPO market works, and Peloton is as good an example of any of the IPOs we've seen over the last 6 months, in that what we're really seeing is a story about demand and access and how that's changed in very recently as a result of a very active late-stage private security market, which is happening in Peloton's case 13 months earlier, where you saw entities like Wellington and Fidelity and Tiger Global and Balyasny, two of the biggest hedge funds in the world, two of the biggest mutual funds in the world. They bought Peloton for $14.50 a share. Peloton raised $550 million. That was 13 months ago. So as a result of that, 4 entities that were historically big buyers of IPOs, not only have they already bought what they wanted to buy, they might even be sellers at this point. And as a result, the IPOs, and you can look at Peloton and we can walk all the way back over the last 6 months, that is a new dynamic.
David, what are your thoughts on valuation?
Well, you know, the question of what is and is not a tech company gets more interesting by the day for me. And, you know, I heard your interview with the CEO of Peloton earlier, and he was saying software is their biggest investment, and that he basically wants us to think of them as a tech company. But, you know, in reality, you could increasingly say the same thing about CBS or Disney or so many companies, Walmart. You know, just because a company uses a lot of software and has an app or has a screen, it doesn't mean that they're a tech company. I mean, this is basically a company that sells exercise equipment that's being given an $8 billion valuation. I think that's illogical.
Gene Munster over at Loop Ventures spoke with me earlier this week, and he said he was really reassured by the fact that the IPO and the filing, Peloton was so transparent in their numbers relative to another company like WeWork, which we'll put on the back burner for now, which maybe wasn't as forthcoming with their numbers. Are you relieved at the amount of financial transparency that we got with Peloton?
Sure. I think that, to take a step back on Peloton, it's more like a $9.5 billion valuation at today's price if you take into account the 60 million shares that are options that are deep in the money. So it's actually, I would say, a very nice valuation for a business with $1.4 billion in sales. And I do think the market is ascribing a certain level of value to the subscription nature of the business, which is very high margin business. And if we want to call it technology, then we can. We almost have to call anything today a technology component. But what does it mean with respect to the transparency? If you want to buy Peloton, you want to make a bet that they are going to grow their user base, that they are going to have very low churn, and that they are going to generate a lot of cash flow. And that's an assessment that the investor has to make. But that's a very different question of, are they a tech company or are they not a tech company? It's purely a matter of how much money they're going to make in the future.
David, as we talk about financial transparency, I have to bring up WeWork. What's the biggest concern, the financials or the valuation at this point?
Well, they're sort of inextricably connected, because if the financials were better, we wouldn't be so concerned about the valuation. I'm going to be impressed if they pull off an IPO before the end of the year at all. It doesn't seem likely. It's unclear what these new co-CEOs actually intend in terms of going public at this point. But I think WeWork is a shaky proposition as a business. And if I could just go back to what Joe was saying about Peloton, you know, whether or not Peloton's a tech company, and of course revenue from subscriptions is all fine and good, but it also has an element of faddishness, and it's a fashion business in a certain sense. Of course, you make some investment in this equipment, but you know, these things come and go as substitutes arise in the marketplace. So again, a $9.5 billion valuation. I was wrong. I thought 8 was too much, but it's 9.5. It really makes me question the rationale for an investor to buy it at this price. You know, let's see whether they can actually make a real business out of it before we start throwing our money at these people.
Well, David, you mentioned that you would be surprised if there was an IPO this year. We have heard that if they don't, they do need to start looking for cash.
I know.
Where do they turn for next for cash?
Well, there was a fascinating article in the Wall Street Journal about, you know, Jamie Dimon's relationship with Adam Neumann, and, you know, clearly they got a lot of support over there. You know, I really don't know. Maybe they'll get it directly from MBS and the Saudis. It seems like at the moment the reputation of WeWork is so poor that it's going to be a rare capital holding institution that's willing to give them very much.
Joe, your reaction?
I would just say that I think despite the salacious headlines about WeWork, they do have some assets, and I think the same Wall Street Journal article referred to what some of them can be. It strikes me that there are some parts of this business that people would be interested in, I can't say much more than that, just that I think that while we can focus on salacious headlines, there's actually some aspects of that business that are doing quite well.
Well, I learned a lot from this roundtable from both sides. Joe Vobril of Farvahar, thank you for joining me, and Techonomy founder David Kirkpatrick, you will be sticking with me. And maybe Jamie Dimon should quit his day job. The head of the biggest U.S. bank is said to have pitched Disney chief Bob Iger on a movie centered around a single woman who enlists an all-female board of directors to pick her husband. The two men told the tale Wednesday at the Bloomberg Global Business Forum in New York.
It was about marriage. It was a marriage counseling thing, something like that, right?
It was about a woman who couldn't pick men very well, so she'd have a board of directors of women who would be testing men for her and picking her husband.
There might be some other movie executives. There might be some other movie executives in the room that would be glad to consider that idea.
I said Bette Midler should be part of the cast.
Iger jokingly called Dimon's pitch gutsy and gave the pitch a C. And coming up, Facebook is headed to Capitol Hill yet again. This time, they're sending COO Sheryl Sandberg. What she's likely to face questions about this time, next. This is Bloomberg. Facebook is negotiating with the key congressional committee for Chief Operating Officer Sheryl Sandberg to testify as soon as next month. This comes as questions stir about the social media giant's market power and its plans for a digital cryptocurrency called Libra. Sandberg's appearance would follow July hearings with Facebook executive and Libra co-creator David Marcus. The discussions are taking place as the social media giant is facing questions, as we have said, about its market power, and I really want to talk about Libra. So to discuss, I'm joined by Bloomberg Technology's Kurt Wagner, who covers the company, and still with me in New York, Techonomy founder David Kirkpatrick. Is it going to be on Libra, Kurt?
I think so. I mean, when you look at the House Financial Services Committee, Chairwoman Maxine Waters has been one of the staunchest opponents of Libra, and she's basically said Facebook stop doing this, has a lot of questions. So if it's not going to be exclusively about that, that will definitely be a part of it from what we are hearing. And so I imagine that Sheryl Sandberg will have to brush up. The Libra stuff does not actually roll up to her at Facebook, so it'll be interesting to know how much she's able to even answer if she does go.
David, your thoughts on Libra, cryptocurrency, new ventures for Facebook?
Well, Libra is an interesting idea. I actually think it's one of the few major initiatives Facebook has proposed in the last couple of years that really makes sense from a standpoint of an actual market need. And interestingly, it seems like the central bankers of the world have sort of recognized that we actually do need some kind of transnational transaction methodology that we don't have, and Libra's put that on the table now in a way that's quite healthy. But is Libra itself likely to succeed in any near-term time frame? Absolutely not. I mean, they've said clearly they won't launch it without regulatory approval. They're not going to get it in any geography that I've heard about. The European Union's made it quite clear they're not interested anytime soon. I don't think there's really any interest in the U.S. The Fed is very anxious about this idea. You know, Facebook's market power and scale, combined with its privacy errors that have been so legion and other errors, I think just make it a non-starter, even though it's ironically a good idea.
So, Kurt, you heard David there talk about the regulatory pressure that the company is facing. This, of course, comes as we got headlines that they're now looking, the DOJ looks like they're launching another investigation. How is this different from the FTC, which also has a parallel investigation?
And the state attorneys general have an investigation, and there's a House committee that's investigating. So there are, I believe now, 4 separate distinct antitrust investigations into Facebook, including the one that Bloomberg reported on yesterday, which is that the DOJ looks like it's going to get in. And it was a bit surprising because a few months ago, there was a lot of discussion that the FTC and the DOJ had actually kind of divvied up the tech industry, and each of them taking 2 of the big tech giants as potential antitrust reasons so that they weren't duplicating efforts. And the FTC FTC got Facebook. And so the DOJ, it sounds like, kind of felt like they were being maybe left out of the fun a little bit, and now they're getting in on this. And so it'll be interesting to see what they each kind of look into, and if they'll be, looking into different parts of Facebook's business, or if they'll be stepping on each other's toes as they go about doing this.
David, should and how Facebook be broken up given all of these 4, 5, 6, you name it, investigations?
I'm not so sure that breaking up the company is the answer. Finding a good answer is hard. I don't necessarily think they should be allowed to knit it together even more tightly, which is what they're currently doing. But when it comes to regulation, I think the company has erred in its strategy in that it's sort of signaled that the only way it's really going to be responsive to the public needs is if it is pressured by regulators. An example of that just occurred the other day when, just as the Massachusetts state lawsuit against the company was about to unseal a bunch of documents about a whole bunch of applications that Facebook had barred because of their misuse of private data, Facebook preemptively released an announcement about that like right beforehand. They're constantly being pushed to do what they should have done already, only by regulation. So it's easy to understand why all the regulators want to get at them. But I really don't understand, frankly, why the FTC and the DOJ both should be investigating them, except that now the president is seemingly upset with them too, as he mentioned at the UN. So maybe they're just being responsive to him.
Well, and interestingly enough, despite this, Facebook is brushing it off and going ahead business as usual, launching yet another new product with their Oculus. And Kurt, walk me through how this fits into their strategy, because you and I have talked about how hardware isn't what you think of when you think of Facebook.
No, it's not. This is not something they're known for. And they had an Oculus event yesterday where they announced this kind of new virtual world that they want to build where you might literally hang out with strangers as an avatar. And when this DOJ announcement came out, or not announcement, I'm sorry, but when this story broke, I started thinking about all the things that Facebook has pushed into in the last 18 months. I mean, they've launched a dating service. They bought this Neuralink company, a neuroscience company, not Neuralink. And obviously they're getting into hardware as well with like the in-home portal stuff. So just a lot of bold moves by Facebook.
Business as usual. Techonomy founder David Kirkpatrick and Bloomberg Technologies' Kurt Wagner, thank you both for joining me. And still ahead, Amazon's looking to write the law when it comes to regulating facial recognition. Why this proposal is not sitting well with the company's critics. That's next. This is Bloomberg. Bitcoin extended its 5-day decline, dropping below $8,000 for the first time since June. Bloomberg sat down earlier with Andy Bromberg, co-founder and president of CoinList in New York. CoinList helps companies raise money through initial coin offerings, or ICOs.
It just points to the fact that these are larger sellers that are going in and dumping into the market, not smaller sellers. There's a lot of data points here that are interesting. The December futures went from a 3% contango, so pricing at a 3% premium to the spot market, down to 2% backwardation, so at a 2% discount to the spot market. So again, these are people selling futures instruments. So the run was being caused by these larger institutional, or at least large holder sell-offs rather than retail selling into the market. That's interesting. That points to a larger set of people making moves.
It's interesting, too, because, I think when Bitcoin actually peaked in December 2017, it basically, peaked to the day that the first, true futures launched. And this was the week of the backed, the ICE exchange, the first sort of, physical Bitcoin deliverable futures, which is kind of a weird contradiction. Nonetheless, so it's kind of notable that we get these sort of intense turning points right at the times when supposedly a new vehicle ends up for money to come into the market.
Yeah, that's right. I think the backed launch certainly contributes to the narrative here. I'm not sure how much it contributes to the actual practicality of the situation. Yeah. Their volumes increased over the course of the week, but it's still very small compared to what's trading on the other exchanges. It certainly affects the narrative, though, and I think that's interesting. What backed signals to me, more importantly, though, is the increasing comfort of institutions entering the space. Backed, launching this physically delivered, and like you said, maybe a little bit of a contradiction in terms, physically delivered Bitcoin future is interesting. It should get more institutions comfortable with it. We'll start to see that kind of octopus of the financial industry reach its tentacles in more into the space, and I think Backed is a big indicator of that.
So as these larger investors, though, get more comfortable with it, why haven't we seen the SEC get more comfortable with it? It seems like we've been waiting for quite some time for them to sort of embrace this.
I'm glad you used the word waiting, because there's a lot of kind of fear about all this bad stuff that the U.S. government has done. That's not really true. There hasn't been a cannonade and assault on the space. It's really just a waiting game in a lot of gray areas. I was in D.C. earlier this week talking to regulators and legislators, and what I found was that it's just this game of patience. They want to make sure that they really understand the space before doing anything, and there's so much ambiguity at this point that it's challenging. And on top of that, the markets are not orderly. It's hard to tell who the good players are, and so it's tough to regulate a market like that.
Now, Bitcoin fell a lot this week, but a lot of the other coins, there's a euphemism that I can't say on air for them, did much worse. Is there still just too much garbage in this space for it to be taken seriously? There's just stuff that's still too frothy, too many projects that just need to go so that people can focus on what actually matters.
There's a lot of garbage in the space, but I think what needs to happen there, I don't think the garbage will disappear by itself. What needs to happen is other good assets in the space need to develop their own narratives and their own usage and have the signal outperform the noise. I don't think the noise will disappear by itself. You need to have more use cases, more adoption, and that's what will drive the attention towards the good projects.
And we still don't see, it's really rare to see anything not just rising and falling with the market. Like, this still isn't a market where good coins go up and bad coins go down on some days. It's basically everything tends to move in the same direction.
I think that's right. Really, the biggest example we do have is that Bitcoin is increasingly uncorrelated with the rest of the market, but all the other assets tend to move pretty much in tandem with each other, absent for kind of freak events that affect a single asset in a significant way.
Does it still sort of serve a purpose, though, as, I guess, a haven asset? I mean, we saw that sort of behave that way earlier in the year. It didn't necessarily behave that way over the recent bout of market volatility.
I think that's a fair point to make. I do think that Bitcoin is developing as this sort of safe haven asset, and every new event that's happening that's making people scared about existing asset classes is a boon to it. Whether you talk about the China trade wars, whether you talk about impeachment talks, whether you talk about recent news with Iran, that is all affecting the price of Bitcoin. People are buying into that narrative, and over time, that safe haven argument is going to become stronger and stronger.
That was CoinList co-founder and president Andy Bromberg speaking with Bloomberg's Romaine Bostick and Joe Weisenthal in New York. Now, another story that we're following, Amazon facing plenty of scrutiny over the use of its facial recognition software and its potential to be abused. And now CEO Jeff Bezos says the e-commerce giant is working with U.S. policymakers to draft regulation on the software. Bezos surprised reporters at Amazon's hardware unveiling on Wednesday, saying, quote, "It's a perfect example of something that has really positive uses. At the same time, there's lots of potential for abuses with that kind of technology, so you do want regulation." Joining me from Seattle to discuss Bloomberg Technologies, Matt Day, who covers Amazon. Matt, I first want to talk about the scrutiny that got Amazon to this point, to where they now actually have to work on that regulation.
I suppose it's been a bit of a firestorm in the last year. The last few years, really, facial recognition technology, which matches an image of a face or a video of a face up to any sort of set of images in a collection, has gotten to the point where it's pretty good and it's commercially available for the first time. And so Amazon's not the only one with the product on the market, but they're one of the more high-profile cases. And so civil liberties groups have gone at them pretty hard in the last year or two, contending that just the existence of these products poses a risk to civil liberties. Companies might abuse them, and otherwise this software was generally a risk of trampling on people's privacy.
Matt, generally, what do we know about the draft legislation that's in the works?
Now, we don't know a whole lot. Bezos wasn't specific. He was rushed away by aides. He had some more stuff to do right after he made his comments last evening. But we do know that Amazon earlier this year came out with a set of principles it was going to recommend in cases of potential regulation. You know, things like government should be transparent if they're using facial recognition technologies in spaces where that technology is active. People should know that it's happening. But Amazon, of course, stopped short of endorsing any sort of ban on the sale of facial recognition tools. They want to keep the market kind of going on its own.
Do you assume or agree that this is in Bezos's best interest? Because if he's the one writing or proposing legislation, he controls the narrative.
I think that's certainly why companies like Amazon have decided to speak up about this a little bit more, is just the pressure that if something's going to be done, they might as well have a seat at the table. And that's what I think you've seen from Amazon in the last year, is kind of a change from a position of, no, we don't really want to talk about this, we think our technology is fine, and are not really interested in further conversations, to, you know, a blog post outlining where they would stand and these potential discussions about potential regulation and being a party to those talks.
What are critics and the ACLU in particular saying in response?
I think a lot of the critics want sort of a broader pause and reevaluation of this. They say we should slow down. This stuff should not be available and in such wide circulation that we're not really thinking through the impacts of new technology. They tend to bring up sort of historic cases of new technology or surveillance systems being used to hurt marginalized groups. And I think they'd push more for a total pause on this in a way that the purveyors of this tech like Amazon and Microsoft and friends would not support.
But there hasn't been a total pause yet, right? How is Amazon still working with current law enforcement and still using this technology?
We're not sure how many adopters it has. This really came to light because Amazon talked about a couple of use cases, sort of experiments out in the wild. There was a sheriff's office in the state of Oregon, and I think it was the city of Orlando, that were piloting the tech. Now, a lot of the users of facial recognition have presumably gone quiet during this firestorm, so we're not exactly sure how widespread it is. But there's been sort of widespread speculation, particularly on the part of critics, that this product on the market from Amazon is likely to be used by the U.S. government and particularly by ICE.
My thank you to Bloomberg's Matt Day in Seattle. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.